You might already have a financial advisor, but do you really understand what you're invested in or why? This is the crash course in investing we wish every adult got. We're breaking down what stocks really are, how bonds work, and how they grow your wealth. Hi, I'm Erin of Truly Aligned.
And I'm Maximilian of Truly Aligned.
Welcome back to our free financial planning series, the framework that our clients pay us thousands of dollars for. We're sharing it here for free. If you're new to the series, be sure to go back and watch the beginning because each video builds on itself. All right, so let's get into it. Max, what are stocks?
Stocks represent ownership in a company. So if you own a stock of Apple, it represents a very small ownership in Apple. You have equity within that company. In general, companies fall in two different categories. A growth company would be like NVIDIA. They have a tendency to be more technology companies where they're putting most of their profits back into the company through research and development to make a better product or service, software, whatever it may be. Now, value companies would be like Coca-Cola. Coca-Cola is one of the most recognized brands in the world. They have a very developed market already. There's already a lot of people drinking their products, so it's harder for them to grow their market share. So for value-based companies, they have a tendency, instead of putting all the profits back into the business, to pay out a dividend. There's a famous dividend from Coca-Cola that's been paying out for decades.
One example of stocks is called the S&P 500, you might have already heard of. This is the Standard & Poor 500 largest companies in the United States.
So it represents the 500 largest publicly traded companies as far as just an index of the overall value of those companies. The S&P 500 is one of the most common indexes that people invest in.
So looking at this graph here, you can see all of the different crises that we've encountered in the United States that have impacted the value of the S&P 500 index. You can see the ups and downs here for each of the different wars, crises, and situations that we've run into as a country that have directly impacted the value. But we'll also note from 1970 all the way through 2022, the value of the S&P 500 has steadily increased over time. If you do have the time to wait out that slight drop, it's likely that you're going to end up with a higher value in the future, as long as you have the time to wait it out.
So we've talked about stocks. The biggest takeaway is that stock represents equity ownership in a company. Now let's transition to talk about bonds. Erin, what are bonds?
A bond is a loan, either from the government or a company, and it's an IOU. So for example, we live in the state of South Carolina. Let's say South Carolina wanted to build a new road. Now they would put out bonds, and people would then purchase those bonds for a set interest rate. When the road is built, South Carolina will then pay back those bonds. So the people will receive the exact amount that they gave as a loan, plus a little bit of interest on top of that. And that's how your money is growing.
The other distinction is that there's government bonds that Erin talked about, but there's also corporate bonds. So when Tesla built their manufacturing plant in Austin a few years ago, they financed that through corporate bonds. Now the federal government has bonds as well. That's how they're able to run this deficit, meaning they're not taking as much money in taxes to help cover all of their spending. So another crucial thing to be aware of is for a lot of government bonds, the interest that you receive from those bonds are tax-free, versus corporate bonds, you'd have to pay taxes on the dividends that are received. On the graph, we have the rate of return for stocks versus bonds long term. Stocks have a tendency to fluctuate more in prices, meaning volatility, they go up and down. When the economy goes down, stock prices get impacted substantially more than bond prices. Though if we look, stocks dramatically outperform bonds in the long run. Now, bonds have a tendency to give steady state rate of return, meaning it's just more level growth, though it's not going to be as much over time. So why is this important? Well, if you have a longer duration of time before you're planning to access your investment funds, like if you're in your 40s and you plan to retire in your 60s, it's more helpful to be invested in stocks to grow your net worth over time, versus bonds have a tendency to be better to access in the short term. It's more of a preservation of your net worth. So it's really crucial to be aware of what you're invested in and then tie it into your goal. The shorter duration of time typically makes more sense to be invested in bonds. Longer duration of time for your goal makes more sense to be invested in stocks.
So for the clients that we work with, we create custom portfolios for them. It includes a combination of stocks and bonds based on their goals, their values, and what they're looking to spend that money on, depending on their age, depending on where they're going, Every portfolio can be different in terms of ratio of stocks and bonds that are within the portfolio, and they're both used for a specific purpose. One for growth, like Max was saying, and one for that steady type of return. Now that you understand what stocks are and what bonds are, you're already ahead of most investors. So next video, we're going to be teaching you how to actually allocate and create that portfolio. What is the balance between the two? So make sure that you subscribe to this series so that you can learn how to create a portfolio for yourself and continue to grow your wealth in a way that feels aligned for you. Until next time, stay aligned.
Stay aligned.